Good evening, everyone. This is Anil Bhansali from Finrex Treasury Advisors. In this current week, we saw record settings by equities from US and India mainly, and equities have been moving higher with expectations of rate cuts coming at least from the main economy, that is US. But the US officials have generally been of the view that rate cuts are too early to be talked about, and therefore the dollar yields have since moved up substantially. Happening at the time, dollar yields were at 3.80, the 10-year yield, and now that yield has gone up to 4%, which is a recent high. The highest was at 5.01 in this entire gamut of rate hikes and now rate cuts. US equities have been up, but the currency market has generally been on a range-bound market. Because nobody is quite sure as to when rate cuts are going to happen in US or in the European economies. Who will be earlier? Who will be taking the call earlier? And therefore, it's a market which is moving between small ranges, and therefore we are unable to actually guess which direction the market will take in the next maybe a few days. On the dollar rupee front, there has been a lot of India being one of the highest recipient in the debt segment, and therefore all this constitute and in the equity segment, though FIIs might have been sellers, they still don't seem to be taking out the dollars out of the country, and therefore the flows continue to hit the market. Last week, RBI was in the market buying about $7 to $8 billion in the month of December. As per last data from RBI, they had bought $2 billion, as against in November when they had sold about $11 billion in November to protect the rupee. Now they are doing the other way. They are now protecting the dollar so that they help the exporters. Exporters may be feeling a bit of a problem because of the Red Sea effect. RBI is there in the market to support the exporters so that they get good levels and they are competitive enough to compete with nearby players like China and others. Asian currencies have generally been on the weaker side and have kept dollar well built against the rupee, as RBI doesn't want to allow a stronger, which will obviously affect imports and will surely not help exporters. Therefore, we're not seeing too much of an upside on the rupee. It's not able to break 80 to 80 for a long time now. It's tried, at least 4 or 5 times it has tried to break this 80 to 80 levels, but RBI has always come and supported the dollar at this point, and therefore rupee has not been able to cross that level of 80 to 80, and we always see buying of dollars happening at 80 to 80 levels, mainly from RBI. Flows have been substantial, and substantial means huge flows coming into the country, with NRIs also putting money into the country, FPIs getting huge amounts, and even in case of equity, they have been investing, though occasionally, despite the fact that the markets are at record highs. Now, on the data front, RBI was again accepting the fact that they may have to cut rates because they just want the inflation to come down to 4%, as Fed also wants inflation to come down to 2%. So both have set their targets, and they are not budging from those targets this time. And therefore, we are not seeing any cuts coming in the near term. Maybe the first cut could come in the month of June, which the market is factoring in, but we're not sure about that because two Fed officials were hawkish, while one was a bit dovish the rate cut front. So again, rupee cannot be very strong. Flows will continue, but will not allow much of an appreciation as RBI is present at the other end. Repeat of the existing government after the elections in the month of May. Most of the investors are very much on the positive side for India, and therefore will continue investing. So I expect in next week the flows to continue, and RBI to keep buying and keep the rupee in a range of 82.80 to 83.10, maybe a bit towards 83.20 possible, which should be a good level for exporters to keep hedging. Between 83 and 83.20, exporters, whatever levels they get, they should keep hedging. Between 82 and 90, importers should keep hedging, and so that they keep their imports a bit lower on 83 side. The importers can actually hold on to their longer term imports and keep hedging the near term imports, while exporters may do a bit of medium term exports. Maybe after the elections, we could see some weakening in the rupee, but again, by 28th of June, we should see the inflows trickling in huge numbers from the JP Morgan in bond inclusion, and that would again keep rupee on an appreciated side more than on an depreciated side. So that's it from my side today. I would again come and give my views on the foreign currencies front next week. Thank you all. Bye bye.